Move on to our next session of the day, which is our second panel session on Fintech, transforming the underwriting in financial institutes. Before I call on the esteemed panel here, I would like to highlight a few points of discussion. How technology is changing the credit underwriting process, AI-powered credit underwriting solutions and how it works, discovering the credit rating with the use of alternate data, and many more. So now, ladies and gentlemen, I want you to welcome the panel members with the biggest round of applause. Starting first in the order of the sequence, can we have Mr. Ankur Jain, AVP Credit Digitalisation from Tata Capital Financial Services. A big round of applause for Ankur. Ankur, welcome to the panel. Please take your seat. Joining next, we have Mr. Siddharth Purandare, Head Credit Risk MSME from Edelweiss Retail Finance. A big round of applause to Siddharth. Siddharth, welcome to the panel. Joining next, we have Mr. Kaushik Khanna, CRO from Ambit Finvest. A big round of applause to Kaushik. Kaushik, welcome to the panel. Joining next, ladies and gentlemen, we have Mr. Anil Jain, Head Credit Aadhar Housing. A big round of applause to Anil. Anil, welcome to the panel. Joining next, we have Mr. Vaibhav Joshi, co-founder and CEO from EasyPay. A big round of applause to Vaibhav. Vaibhav, welcome to the panel. Always a pleasure having you. Joining next, we have Mr. Yogesh Thakker, Associate Director from CreditRisk Solutions. A big round of applause to Yogesh. Yogesh, welcome to the panel. And now, ladies and gentlemen, would like to call on stage the honorable moderator for the panel, Mr. Chandan Mohapatra, Head Credit Risk from FlexiLoans. A big round of applause to Chandan. Chandan, welcome to the panel. And we have a full power-packed panel here. So, Chandan, all over to you. And captain of the ship and moderator, looking forward to a great discussion.
Hello. Good morning to all our panel speakers, and a very good morning to all of you. Before I start the discussion, what I think is that at the beginning, let me give a vote of thanks to all of you, particularly because this is at the flag end of the month. We all in the credit and risk, we know, right, what a typical month end looks like to all of us. That too, particularly in a month which is already 10% short. So when we are at 24th of the month, we are almost at the 28th, 29th of the month. It takes an effort to kind of come and join us today, and a big thank you note to all of you. From the panel side, we will try our level best to make it worthwhile for all of you over a period of next 40 to 50 minutes. While we kind of keep it a little more interactive with all of you, at the end, we will keep last 5 minutes for question and answers, and we do expect some questions from your side. Please feel free to kind of ask whatever questions that you have in this spectrum. So before I formally start the question, maybe I'll do a quick introduction, which he has already done, maybe a kind of name to the face introduction. From towards my right, I have Mr. Thakker. He has been Yogesh Thakker. He has been an industry stalwart in terms of data handling in his earlier role. I mean, he has handled risk, compliances, business analytics, and whatnot. When it comes to maybe data, alternate data, which will be one of the questions that we will discuss, we will look forward to your input. Vaibhav, Mr. Vaibhav, I think we just saw him on the stage. He is a co-founder and a chief executive officer at EasyPay. He brings about 22 years of experience across verticals, be it credit, risk, digitization, product, analytics, business analytics, so on and so forth. Next to Mr. Vaibhav, we have Mr. Anil Jain. He is a chartered accountant and brings about more than 18 years of experience with him. He is currently working as head of credit at Tata, Aadhar Housing. Next to Anil, we have Kaushik. He is the chief risk officer at Ambit Finance. He brings more than 20 years of experience, particularly in the credit and risk era. So I think, Kaushik, we will really look forward to your input when it comes to how do we kind of manage credit underwriting process, the entire risk management process itself. Next to Mr. Kaushik, we have Mr. Siddharth Purandare. He currently manages MSME vertical as head of credit at Edelweiss. He again is another industry veteran and brings about 19 years of experience with him across business verticals. I think he has seen it all be it retail, MSME, trade finance, so on and so forth. Siddharth, we will really look forward to your inputs here. And Ankur Jain, he is Associate Vice President at Tata Capital. If digital or the digitization is the question in your mind, he is the go-to guy. He is the master of how the underwriting process can be digitized, so on and so forth. He is a chartered accountant and brings about 14 years of experience with him. And finally, myself, Chandan Mohapatra, Chief Risk Officer at FlexiLoans. I'm a chartered accountant and been in this industry for a little more than 18 years now. Before we start the discussion, let me put it this way. Are you all up for a question, if I may ask? Yes? If I have to ask all of you, right, what are those couple of things which, as per your experience, has changed massively over a period of last 8 to 10 years? How would you call them out? There is nothing right or wrong. You can just take your time and tell us. Those couple of things within the lending industry that has changed massively. Yeah, CIBIL score, yes. Anything from this side? Yes. Digitalisation, absolutely right. Anyone else? Scorecard-based underwriting, that's a very valid thing. Anyone else want to chip in? Okay. I think all the answers that you guys said is true, right? Because we all have seen, particularly in the credit risk, how things have evolved. How we used to look at a file maybe 8 to 10 years back and what it is today, right? The physical files have almost kind of vanished. But if you look at all these, maybe the way I look at it, these are the output. The underlying factor which is kind of making all this happen, which is kind of enabling all this, is technology, right? Would you all agree with me? So maybe coming back to the today's context, we will try and discuss how technology, in essence, has kind of changed the entire underwriting, risk management process, and so on and so forth. Just to give a number, everyone in the credit risk era would connect to numbers far better, right? And the panel here, if I add their experience, it is little less than 100 years, right? So I am really excited to next 40 minutes of discussion with each and every one of them to kind of hear their thoughts and how have they experienced last couple of years changing massively in our way of life. So with that, maybe I'll start with my first question, and I will need Mr. Vaibhav's thoughts on this. So Vaibhav, just to get the context right, the technology, digitalization, the way the scorecards has kind of helped in the underwriting process, customer journey, product involvement. So if you have to summarize a bit, if you can tell us as to how things have changed on a very overall basis. Over to you, Vaibhav.
Thanks, Chandan, and a very good morning to all of you. So I think lending is one of the oldest businesses that there is. When we talk about BFSI, lending is where the core lies. Yes, there is money management. Yes, there is payments. Yes, there is TPP, insurance, wealth, etc. But lending is where the core lies. And the fact that there are at least 2 fintech guys, me and Chandan, sitting on this panel talking about credit risk and alternate data is a testimony to that. So if you have a look, the way this industry has evolved, there used to be banks who used to lend. Before the banks, there used to be money lenders. Even if you go to rural areas today, then there are loan sharks or sahukars who still lend at a far higher interest, maybe 5-6% a month. There is formal, informal lending that goes on. But at the crux, at the end of the day, that entire lending has to ride on certain assumptions. That assumptions is actually the end result of the risk factors that you consider for the person or for the entity that you're lending. And it has really evolved over a period of time. Okay? So when digitization started, you started seeing, things like LOS, LMS. From banks, you started seeing NBFCs. Then the era of SFBs came in, and now the era of fintechs have come in. There was an era of digital lending apps, and I'm saying there was an era specifically because now, every fintech is actually looking at lending, barring a few who may have taken insurance or wealth as a pivot for as their primary lending, primary revenue product. So at the end of the day, credit risk underwriting and riding on not just the traditional data but alternate data becomes extremely, extremely important. And why does it become important? Because if you guys have heard a term known as NPA, okay, every lender wants to ensure that the NPA does not cross a certain percentage. And to make sure that the NPA stays below a certain percentage, that is where these parameters come in. Every one of us would have taken a loan. The first time I, as a young chap, went out for a loan was for the student loan. And the loan was actually given to me because I was going overseas, but both my parents were bankers. And the loan was given basis, the salary of my parents and the house that they owned. Okay, the underwriting parameters used to be that. Eventually, today when a student goes for a loan, there are a lot of factors that come into play in terms of, what institution is he going for. If he's going for an institution which is right there, if he's going to a Harvard or a MIT, then probably, they will not ask for anything because they know if this guy is going to complete his course, then, he's going to be my customer for life, forget this loan, I'll be able to service 10 more products to him. That is how fast this has changed. But let me talk about the industry that I service. I work in the MSME space today with EasyPay. And MSME, the medium, the micro and the small MSMEs are where credit risk underwriting and usage of alternate data is, I think, today at its peak. Now, for a small dukandar to go ahead and take a loan earlier, he would walk into a bank branch and the bank would actually scrutinize him. तुम्हारा क्या asset है? कितने साल से दुकान चला रहे हो? What is your CIBIL? If not CIBIL, what is your experience? So on and so forth, a lot of things. Now, majority of these guys often do not have bureau. They don't have bureau scores, okay? When Chandan asked the question, somebody said CIBIL, somebody said digital, somebody said scorecard, okay? So they are all relevant over here, and I think they are also relevant across all the segments. And I'll tell you how it has evolved. So for a person who doesn't have a bureau data, would you underwrite? It's a question I would like to ask all my fellow panelists. A person who does not have bureau data, would you underwrite? And if so, to what extent are you ready to take a risk on that person? And that is where alternate data comes into play. And how? So earlier, now let go of the era of LOS, LMS, they are rudimentary things. Came the era of lending tech, and then came the era of credit AI, where there is a smart AI that actually works on creating a risk profile of that entity or individual. It actually creates a scorecard, and then basis that scorecard, it gives a probability to that user that, hey, this is your data, this is your scorecard, whether you're going to get a lending or not, this is the amount, this is the probability. Now, when those scorecards are created or when the decisioning is made, there are a lot of parameters that are available today in form of alternate data. So other than the traditional bureau data, there are parameters where we talk about, things like, does he have GST? Is he filing income tax? Okay, if he's not doing those things, does he own a premise? Does he have a house? Does he have a shop? Can he provide an electricity bill? How long has he been having that shop for? Okay, what is the lat long? So what is probable profile of that person? If he's having a shop in a pin code which is 460001, he's probably in the most center of the town prime area. Okay. Secondly, invariantly, and what we end up doing in India is, and that is because of the lack of data privacy or the intent behind it for that matter, we end up giving a consent to almost every app in our phone, and because of the smartphones, access to that alternate data has become very, very simple. So I don't know what is the last app you guys downloaded, but I'm sure in the TNC you guys just scroll through it, clicked on I agree to all terms and conditions, proceed. The moment we do that, we invariably end up giving so much access to that particular app. And I can tell you, if you give me access to your phone, I can probably tell you, even if your phone was, if not me, but Google can definitely tell you, even if your phone was off, or even if your location services were off, it was in plane mode. From what point to what point did you travel? When did you travel? Okay. There is something known as, so we lenders rely on something known as SMS scam, bank statement scam. And generally it is done by scrubbing the SMSs. So your SMSs are read, and when those SMSs are read, the financial information is taken, and then basis that, a financial near replica of, your bank statement or what are the income and expense lines that you do, payables, receivables is created, and then it's compared to the bank cam. Now, there is a fantastic account aggregator framework that has come in, but unfortunately only regulated entities and their partners can plug into account aggregator. So what do other apps do? They actually get into this. Alternate data has gone to an extent where, social media scrubbing is done. So whether this person has Facebook, Instagram, LinkedIn, Twitter, how long he has had that particular, he has been on the social media platform, who are his friends, who are his families, okay? Data availability is very simple in those sense. And Chandan, what has also evolved is, because of this digitization, the frauds have also evolved. Let me give you a very simple case of fraud, okay? And I'm not going to touch upon lending, but this is very important from a risk perspective. So, we give our Aadhar card photocopies to 10 places, okay? And at the same time, when we go and register our house, we actually also end up giving a biometric. I first-hand encountered this, where, I came across a place, a town, where that data is actually been sold. The housing registry data is being sold. The Aadhar card is also there, your biometric is also there. And what people do is, there is a product known as micro ATM, if those of you who know payments know. So under that, there is Aadhar enabled payment system. You can actually walk to a BC agent or a banking correspondent agent. You can put in the Aadhar number, you can put in the biometric, and you can withdraw cash from the account. You can first come to the balance of that account. And we encountered this fraud somewhere where we realized that, wow, what's happening? You have access to Aadhar data. So the moment digitization goes in, frauds also go in. So that is where, alternate data is extremely important, but what is more important is we as consumers realize that to what extent alternate data access do we have to give. Another 20 more seconds and I'll hand it over to you. When we go to a website, it says accept all cookies. First thing you do is don't do that. Go to details. And there, you select only on those cookies which are important cookies, not accept all cookies. Because your data scrub actually starts from there. Forget the apps. The apps would actually scrub your phone in and out. The app would know whether you have Tinder or not. Okay, the app is, if there was a element which was there to, screw you, then trust me. Blackmailing is the smallest of the things. That is how much access we give. And that is the type of alternate data that is available. I know it's scary, and that is why I think we need to be aware, and the onus lies on lenders, where while we are creating creditrisk, while we are, talking about alternate data, we also make the consumer aware about it. Thanks, Chandan.
Thanks a lot, Vaibhav. When he started with that Sahukar thing, I was so happy. But the moment he got into that Aadhar card fraud, I started getting a little scared as to, because at least I end up doing that so often, right? We go to a Xerox shop, we give our Aadhar card, PAN card, he takes a photocopy, we just walk away with that. And as you rightly said, Vaibhav, the first validation or the first checkpoint of these frauds not to happen is with us, and maybe then the lenders. Because as individuals, not as lenders, as individuals, once we are kind of conscious about what we are giving, to whom we are giving, and what purpose we are giving to, I think then the step 2 is about lenders coming in, regulators coming in, so on and so forth. Okay, so thanks a lot, Vaibhav, for bringing a very holistic approach to this entire thing. Maybe I'll take 2 steps back. We will start with something called as an underwriting process, which is, to me, is one of the most critical pillar in the entire credit and underwriting process. Because that is where we take a lot of decisions on whether to take the customer ahead, whether to tell him no, whether to put him in a manual check, so on and so forth. And this particular process has evolved massively, right? From those days that we used to go through the physical file, touch and fill of the KYC, the application form, documents, to today where we don't even get a single hard copy of a file. I mean, single hard copy of even a page of a KYC document of the customer. So with this background, I'll go to our second panel speaker, Mr. Siddharth. If you can, at a very basic level, if you can summarize as to what all things, as per you, has changed the entire underwriting process in last 8 to 10 years time span.
Thanks, Chandan. Good afternoon, everyone. See, all I can say is technology is one of the biggest enablers for us in underwriting. So what it has helped is to build in process efficiency and obviously a faster and superior decision making, leading to a better customer experience. So when I say process efficiency, what happens is the start of the underwriting journey is typically the documents which are required to assess the customer. So here we work on fetching data from source. I think that is what we have built in our originations platform, has all the APIs integrated thanks to India Stack and other technology service providers. So quite a few of our data is fetched from source. From a customer perspective, it is more efficient because the only thing which is needed from the customer is his consent. So fetching data from source obviously builds in that efficiency, though the current ecosystem needs to evolve because as of now, we need multiple consents from the customer for multiple documents or multiple data that we need. But maybe the account aggregator framework is a step in the right direction where basis one single consent, we may get a lot of data which is needed. The target segment where we operate, which is the MSME, not all customers typically are consent inclined. There will still be a set of customers who would give us some documents or soft copies because they would not be wanting to get that consent mode. So for them, what we use is automation. So there is a set where we fetch data from source. In this set, what happens is that I get validated and verified data at the first instance. For the second set, we collaborate with a lot of technology service providers for automating whatever information is given to us to convert into data in quick time. In both this segment of customers, I think we work with a basic principle of zero data loss. So our system or our origination platform is capable of capturing the entire data points which are available to us. It may not be relevant at this point of time or not may seem relevant at this point of time, but what we're doing is we are capturing the entire data into data tables which may be used at a later date. So imagine the kind of data that we capture which then flows into my scorecards, which eventually betters the output or the predictability of the scorecards. So my scorecards, when they do a red, amber, green kind of assessment of the borrowers, they have quite a huge amount of data with them. So obviously the red customers typically where the predictability or the probability of default becomes higher, we kind of move it out of the funnel. And only the curated data, which is typically your amber and green, would move to the underwriter. So before it moves to the underwriter, we have a lot of fraud checks built in the platform. So when the actual data moves to the underwriter, it has gone through multiple checkpoints. And that is how the underwriter is also, can decision it faster or process it faster. Another set, what we're doing is we are, for a certain set of customers, we are using video PD as an alternative, so which also brings in efficiency. So what happens is my start to end decision is, very quick. That is also leading to that customer experience. We are also running some POCs around technology use in legal and valuation, but happy to have conversations with anybody who has a solution around that. And lastly, Chandan, what happens is all our platform is built on low code. So one of the things when you underwrite and when you have technology at as a backup, as a back end, what happens is our time to market becomes faster because in the current environment, our underwriting has to be dynamic. It can't be static models running for a year and then we keep on changing. It has to be dynamic as and when the micro environment changes. So since we have a low-code platform, all these new API integrations, new policy changes, our time to market is faster because it's a low-code platform, simple to kind of modify and tamper, and it's an in-house proprietary platform, so we don't even have to outsource or give it to somebody to make the changes. So net, what has happened is because of technology, while the efficiency is built in, it has brought in a lot of dynamism in my underwriting. And So I think on a go forward, the role of technology in underwriting is anyways going to grow from here. So that's what I think.
Thanks, Siddharth. I think you touched upon some of the very crucial points like getting the data from source and storing it. Maybe today you don't realize the relevance of the data, but maybe after some time, after a few months, years, maybe you will eventually realize the relevance of that data, and hence then you build a score model around it. I think third thing, quick takeaway from your thing is what I think you have built a low code, no code model, which kind of gives you fungibility to do those changes very quickly and go to market. Maybe I'll quickly move to Ankur. If you can, because you have been managing the entire digitization process at Tata Capital for some time now, and if you can throw some light as to how things have changed, taking a cue from Siddharth.
So already a lot of points have already been covered earlier. I just wanted to bring it up across into three portions now, which has actually impacted a lot on the underwriting. One is obviously the big data, which is obviously everybody is aware that how the big data is working, and then now probably we have been hearing that big data is the data is the new oil. So how it is crucial and how it is going to impact in our underwriting, that is one of the important piece. Now the second piece which I take it up from the big data is the machine learning. How fast you are learning with that, and then how you are making a lot of models. So Mr. Vaibhav has already covered a lot of alternate data piece. Whatever information which I have already or which I have been capturing over a period of time, how this is shaping up to me to make or use it for the more underwriting piece, that is one of the very, very critical piece which I think is going to be. And then third, which I bring it up across another piece, is the artificial intelligence, how we are going to build it up across and then work around that, which is going to impact in overall underwriting piece. Now fintechs when they came up with this alternate data piece, because a lot of people had the traditional lenders were giving or making lending basis on the whatever data information from the bureau which was already there. So people always felt, okay, fine, why not to go for it? Just to give you a brief understanding, a recent study came in, and then the underwriting piece, how it is going to changing or how it is going to change came up. There are 22% people who had thick history, right? 20% who had thin history. 8% were the people who had just came into the credit piece, and rest is still untouched. And that is where the piece probably fintechs tried to capture, and then they're focusing that, okay, fine, the traditional underwriters or traditional lenders are already there in this industry. How we are going to capture the untouched people or maybe those who are coming up. So then when you talk about thing, Gen Z is one of the very, very niche area wherein they are going to come up, and then obviously India being still a very young country, this is going to shape up a lot of things. So then how the underwriting models are changing and then how we are taking up, this is one of the very, very important things. One piece which I wanted to bring it up across here is that a lot of people or a lot of lenders have already worked upon the acquiring of the customers. We probably, we in the sense, obviously the thought process is always that we wanted to have a manual touch whenever we are interacting with the customer, probably whenever we are lending to a customer, that thing is still there in our mind. And that's where we always feel, okay, fine, I want to have a video PD probably, I want to have a telephonic conversation with the customer. Now the industry which is changing is basis on the data which you have got, basis on the patterns and basis on the portfolio, how it is behaving. It is shaping up that way that now I want to have an instant decision giving it to the customer, and then how it is going to behave to me, and then basis of that learning, probably I'll change my underwriting, I'll change my business rule engine, and then I'll take it forward. So these are my learnings over these years which I have been into the underwriting, and then how things are moving up across.
Thanks, Ankur. Moving to Kaushik. Kaushik, you have been an industry veteran, seen it all for last 20 years. What do you bring, if I have to ask you, because we spoke about data, how the data is changing our way of underwriting, how the digitization has changed. How do you look at it when it comes to the entire change of process in the underwriting piece?
So thanks, Chandan. So I think most of the good points have been well covered by Ankur and Siddharth. So I will just build upon that. See, obviously, if we see, I think last 10, 15 years, moving and evolving from a thick underwriting or a manual processing towards digital processes and digitalization, and we know app-based journeys, assisted journeys, web-based journeys. I think so many things have come up, and this has really, really eased down. If I would, I think, divide it into three parts. One is, I think, moving away from complete physical files to digital files. Your document collection has become so easy that you are now able to collect, whether it is KYC with the help of India Stack, or whether your GST data with the help of OTP-based consent, or whether it's banking or financials with the help of your AA or multiple other OTP-based or API-based stacks which are now available in the market. So this gives you more reliance on the data what you are getting, and this gives you more speed. And with the help of that, and once you have got this entire set of data for different set of products, whether it is consumer-led or P2P lending or your BNPL or MSME loans, whatever it is, to some extent, you are able to automate a lot of processes. And that was the key pain area, what we have seen in past. With the help of automation of processes, this has now, I think, reduced that traditional CPAs, your manual CAMs, your errors in the data. I think that has totally gone away, or to some extent it is going away. Everyone is moving in that direction. You get data with speed, you get correct data, you are able to bypass a lot of processes like FCU and everything if you are getting correct data from the source. And how smartly then you are using that data, what Ankur and Siddharth told, with the help of data analytics, with the data consumed in the BRE, the rule engines, how smartly you are able to use that data so that your underwriters just have to review the screen and segment it basis red, amber, green, whatever we say, or wow, super wow, and accordingly take all those smart decisions. And with so rich data available, I think your income estimation, your obligation estimation, your verification of a customer, whether he's living there or not, with the help of latitude, longitude, whether reading the device data, checking whether he's working in that company or not. There are so many APIs available. You can verify the EPFO data. So with the mix of this alternate data, with the mix of the data getting from the source, with the mix of data getting through the consent, with the help of API, and then massaging it with your strong LOS and your BRE systems, I think lot of efficiency has come into the system. And though this has started with small loans, consumer loans, but I was just reading 50% of our personal loans are completely digitized. 15% of MSME loans are completely digitized. There is a survey which CIBIL and SIDBI did, and they said that overall time of decisioning a MSME customer, microloan, has come down from 33 days to 19 days. SIDBI is talking about 72 hours time to decision, what I'm talking. So PSB loans, 59 minutes loan, we have seen that initiatives, OCEN. So a lot of initiatives. I think this regulatory changes, a lot of good initiatives which are coming up. I think this is what I will say, this is a step in right direction. And overall, I think going forward also, not only in underwriting, this also helps in better portfolio management as well. You are able to segment your customers in a much better way. And what Ankur was saying, you can make changes in a fly rather than waiting for 1 year or a 2 year seeing the portfolio performance. With so rich data sources available, you can make changes in a fly, and that is what the agile environment is. That is what the low-code code platform is. So I think this is what is transforming and helping underwriting in a big way.
Absolutely, Kaushik. Maybe I'll just move to the next concept quickly, which I think all of us are kind of listening every day in, day out, which is called artificial intelligence or AI. Maybe next 5 minutes we'll spend understand what exactly AI is, maybe as the step one. And step two, we will try and understand how it is kind of helping the entire credit and risk management space. So I will move to Yogesh. If you can quickly tell us, give us a very brief idea about how AI works first, then we'll get into how it is helping us.
All right, thanks. Good afternoon, everyone. Sounds like a misnomer, no? Artificial and intelligence. Two words in the same sentence, artificial intelligence. So what is AI? Probably, in a very, crude and simple terms, I'll say, you bring the human intelligence onto a system, and we started calling it AI, right? Industry stalwarts are already said so many things, so many buzzwords, no code, low code. But there has been huge change in technology in probably last 10 years. And the trigger point for India specifically, or world over in fact, was the COVID period, right? Bankers did not stop lending at that time. And that's where the AI, the adoption of AI has changed a lot. Artificial intelligence in terms of, so before I start speaking about AI, maybe I'll spend a couple of minutes on the industry structure and how it has been there, right? I can see some silver hair in the audience, and maybe they can resonate with me. 60 years back, the credit delivery was something which was very, community-based, geography-based. Not everybody has access to credit. Then we moved to the nationalization of the banks and probably big corporate getting, into the banking space lending. Then we had a focus on the individual lending, retail lending, education loan, housing loans. And now this is, industry 3.0, which I like to say is industry 3.0, where the human angle is somewhere going at the back of the screen, and the technology is coming to the forefront. Things are still same. We are still doing the credit underwriting in the same manner we were doing in probably 10 years back. It's not that, these soft signals were not getting captured, but then you were relying on the human intelligence to go and, actually do that kind of verification for you. Someone mentioned in the, from the audience as well as in the panel that, you go and do a soft skilling. Who is your, where are you spending? Where are you going? Who is your, network? Who are your suppliers? Who are your buyers? So all that stuff was also happening. But now technology is aiding it. The speed of execution, the delivery of giving the credit, decisioning system, that has improved tremendously, right? And as in, so just briefly also want to touch upon the associated risk that comes with it. Probably what I have seen is that wherever the ease of doing things comes, a complacency sets in, right? And we mentioned, underwriting models. Within underwriting model, you will have a personal scorecard, you will have a retail scorecard, you will have a probably within housing also, we will have affordable housing, we will have a affluent housing, we will have a affluent car loan. So many segments, so many micro segmentation is happening. Think about from the model perspective, right? Probably for the same space, you end up having 15 models, and all of those are working together. 15 models, 50 models, 70 models, 100 models. How do you maintain those models? Which model is important to your numbers, right? Suddenly you see 6 months down the line, one particular model is accounting for maybe 10-15% of your book, right? And God forbid, have you done any kind of maybe some weakness exists in that model, 15% of portfolio is getting impacted by it. So industry should also start thinking on those lines. So that's where, not only the underwriting piece, the entire pipeline of the credit, that's where, the technology should, in fact, it is already happening. So if you see, after underwriting, your disbursal happens. All of that is now being done very fast. As the gentleman mentioned, 19 days. Why 19 days? Even, 19 minutes mein loan disburse ho raha hai, and we are all seeing it. But what happens after the loan disbursal? You still have to recover it, right? You still have to get that money back. How do you, look at that section? maybe you still keep on evolving those models in terms of recovery rates, in terms of what kind of pattern has changed in your customer, and how does that reflect on his repayment capacity, or all of that, that pipeline, the entire credit delivery platforms. I think lenders should also start looking at that space also.
Thanks, Yogesh. Maybe I'll just quickly move to Anil. See, you have been in a leadership role at Aadhar Housing, managing multiple products. How do you look at AI has kind of evolved your organization as a whole, and how you look at it personally changing for market as a whole?
So, good afternoon, everyone. Chandan, very importantly, the thing is that when you say that I am working for affordable housing. Now, what is the affordable housing? Because in the industry, affordable world is very wide. Some people say that 35 lakh rupees loan is affordable. Somebody says that 25 lakh rupees loan is affordable. And some of the people think, no, up to 50 lakh is affordable. So affordable to me is basically not affordable, but lending to the unorganized sector.
So true. Yeah.
Okay? So basically the affordable, when we say the affordable business, it is unorganized lending, lending to an unorganized customer. Now, we were talking about the multiple data source and the bureau data, the scorecard, everything. But who want to touch the NTC customer, new to credit customer? Because every lender wants that, Vaibhav was telling that my NPA should be low, my ROI yield would be higher. But and for that reason, nobody wants to lend the new to credit customer. Now, if we look at that, if you remember that 2014 Government of India has come up with financial inclusion. What is that? 90% of the Indian population belongs to the area of tier 3, tier 4 kind of cities, where these people are untouched in terms of lending or in terms of formal segment. So how we will lend to these people? Like we were discussing certain things that for this customer, we will not have the bureau data. This person might be earning in cash, maybe are working in a cash salary, or maybe having a small shop, okay, where he is dealing entirely into cash. So he will not have the banking habits also. So what are the data? And secondly, if we talk about the different kind of bills, the payments, etc., most of these people are residing on rental. So basically, in terms of the data, we don't get anything. There the AI role comes. Because when we talk about the AI builds up all these kind of things that, okay, it is not only this particular customer about the data, but it is the artificial intelligence which build up about the population that, okay, if a particular customer belongs to this segment, this is the customer profile, this is the vintage of the customer into the business, what is the age range, what is the area or the pin code, and how the other people in that area are behaving. There the AI role comes and very handy for the underwriter. Because underwriting person cannot evaluate basis the data points, he has to go by the AI data. So that is very, very important, and this is how it is helping for financial inclusion for Government of India.
Thanks, Anil. I think thanks for explaining it in so simple terms. We all could relate to what you are saying. But maybe I'll quickly, because I have paucity of time, maybe I'll quickly move to the next topic that we have, because we heard everyone talking about data, right? Because I think that's what kind of helping all of us to do what we want to do in that quick span of time, giving transparency to the customer in terms of our loan processing, so on and so forth. But I think in the data space, I think the new buzzword has been alternate data, right? A lot of us spoke about alternate data. Data historically has been bureau data, banking data, demog data, right? Now there is a fourth pillar which is talking about alternate data. Maybe with that, at least I am extremely excited to understand how this alternate data is currently working, what are the sources, and how we are kind of using it in our underwriting and risk management process. So I'll maybe quickly move to Ankur. If you can explain a bit on the alternate data and kind of open this myth about how it works, what it is all about. Yep.
So everybody has interacted or maybe have the Gen Z category of people in their houses. So when I say Gen Z, people who are born maybe post like 1996, they are considered as Gen Z. obviously, when we just think on this line, these people are like 25, 26 years, or even less than 25, 26 years. How would these people have a credit history, right? That's the most important point. So then when I was just referring my previous point, I just mentioned that almost close to around 50% people do not have any bureau history kind of. How do we go and then lend such kind of customers? Because these would be definitely, and the kind of salaries which the Gen Z people are getting now, right, is humongous. So then obviously when you think they have the earning capacity, probably they even have the intent. And that is what we always think from the credit point of view, your intent and you have the capacity, but you do not have a bureau data. So this is one piece I'm just touching upon now. The second piece is obviously when we talk about the rural India, there also we do not have the bureau history. Just to give you a small understanding or point, India has got 1.2 billion mobile subscriber, or maybe the people who are using the mobile number. Out of this, close to around 700 million people are using smartphones. And an average data usage for these people across India would be close to around 19 GB or 20 GB, just to take a ballpark figure. Now, understand this is the immense data which we have got on the mobile. Now you may have different kind of datas on the mobile. If I go in the detail, probably we'll spend the whole day in this. So then I'm just trying to put it across the kind of contacts you are having, the number of contacts you are having, the how much social media you are using, how much other applications you are using, etc., etc. So the data points which we are talking about becomes an alternate data to you. And how do you use this alternate data into your underwriting would be the new age of underwriting. That is what I will be putting it up across here and then closing and then take a reference from there. Thank you.
Thanks, Ankur. You know, when we talk about data, alternate data, it's the PI data, right? A lot of them are PI data. I mean, so one side, it gives a lot of empowerment to the lender to kind of make those wow journeys for the customer. But at the same time, it kind of creates a lot of responsibility on the lender side to kind of store it properly and utilize that data only for the benefit of the customer, right? The privacy bill is around the corner. It should be out any time from now. But I think with that as the background, one is that we will utilize the data at the time of onboarding. Then there is a consent from the customer and hence the data came in. But to kind of monitor the overall portfolio, we would need a continuous data feed, which is again consented by the customer, right? Otherwise, I'll not be able to use that. And if I fail there, my entire portfolio management goes for a toss. Maybe I'll come back to Kaushik. How do you look at this consent data thing kind of evolving over maybe last 2 years or so?
Yeah. So I think we have discussed, you rightly said about the onboarding, about the taking the consent, storing, underwriting, and then the alternate data. Yeah. So friends, according to me, I think this portfolio management or this using of this perpetual data, which is a consent-based data, and monitoring the portfolio on ongoing basis, according to me, is an evolving space. We are not so evolved over here. I will give different examples. I think the field which is more evolved and more penetrated over here is the bureau-based data, because once you have taken the consent, you are able to get the bureau scrubs or the different triggers from the bureau, which definitely helps you in a perpetual way to again understand whether at what point of time this customer is inquiring about a new loan, what is his credit hungerness. If he has started defaulting with some other borrowers, maybe he is paying to me on time. That's another trigger which you can get from the bureau. Similarly, a borrower who is doing a lot of inquiries, lot of shopping in different set of loans. So with the help of scrub data, what you can get from bureau, where you can segment it in 4 quadrants, what we normally do is good with me, good with others, good with me, bad with others, bad with others, bad with me, and bad with me and good with others. And then chalking out an action plan for each of the segment. Where do you step up your collections? Where do you have an early warning signal that you need to monitor that portfolio in a better way? Maybe he can start defaulting in future. And accordingly devise a collection strategy, accordingly devise a proper early warning portfolio management strategy. And along with that, getting the triggers on daily basis, what I was telling. So those triggers can be inquiry-based triggers, those can be default-based triggers, and then accordingly taking a proper monitoring action, whatever is required, maybe cross-selling the customer for an additional loan, or maybe getting an alert that this is the time to exit this account. Maybe he's doing a lot of inquiry, maybe his trade lines have started bleeding with other borrowers. I think it's time to exit. So this is what the bureau helps. Second is a controversial topic, and we have seen a lot of evolution in terms of digital lending guidelines, the consent-based data using the device data, what alternate data, what we are talking, like SMS scraping, you're using what all applications you are using, keeping a track of the location where he is as of now, keeping a track of all the contacts and all this, the device data, the type of mobile he is using, what he has changed, when has he changed the location. So that subject to consent, subject to the regulatory changes, that can also be used provided there is a proper consent in keeping a track on the customer on a regular way, or for your collections, or for tracing the skip customers, or for seeing that, again, scrapping their SMSs and seeing what all new debt that customer is taking. Has he started defaulting? Is there any check bouncing which is happening, which we can scrap through the SMSs? So that's again an early warning alert, what can be used. And third, I think the evolving space, what everyone is looking forward is the AA part, which is still evolving, which has just started. Like with the help of AA, you can get the banking data direct from the source. FIPs and FIUs, so financial institutional providers provide that data. Over there, if the customer has given the consent that yes, you can use the data for the entire lifetime of the loan, then there is no need to take any additional consent. You can use that banking data throughout the lifetime of the loan for, again, reviewing his bank statements, monitoring the sales, seeing that whether regular salary credits are happening, he's sticking in the same job or not. So I think these are some of the tools, some of the ways which are available where you can build multiple logics with the help of triangulation logics, with the help of bureau, with the help of device-based data, with the help of AA, with the help of certain other triggers, what you can get from, there are multiple companies who provide MCA-led rich data, like any trigger in terms if any director is disqualified, any company whose name has been striked off. So you can get all those triggers in a fly. There is no need for you to continuously checking it and all this. And once you have onboarded a customer, if you have fitted everything in your rule engines and this monitoring actions, you can use that very intelligently and in a perpetual way for monitoring the portfolio for the entire lifetime of the loan.
Absolutely, Kaushik, absolutely. Maybe I'll just move quickly to Anil. If you can quickly summarize as to how do you look at this particular thing that Kaushik just spoke about on the consent data, how do we get the data, use that data for the benefit of the customer? How do you kind of look at it quickly?
Yeah, so Chandan, what Kaushik said, very true, that it is a consented data. As of now, if we talk about the consented data, only two things are available as of now, Bureau and the AA. Okay? So there we get the data. In Bureau also, consent we take for the lifetime. AA we also take the consent for, we can take the consent of one time or lifetime. So usually the bankers, the financial institution take the consent for the lifetime. But if we look at the other data, there are various kind of data we used to get through a fintech, which is as of now not basically a consented base. We have the fintech system where people have the API through Income Tax Department, GST Council, and GST Department, and various other data, MCA. So these people provide us the facility that underwriter with a click of a button get all the information of the customer.
True.
Now, if we look at whether this is something, because if we apply for a loan, we also get been screened, and the institution where we apply the loan, they can also get the data. Now the question is that how they get the data. So it is a very, very crucial and very important thing that as of now, it is coming towards the privacy, that whether customer has the privacy for the data or not. So like initially somebody has said that when we download any application, usually it asks for certain things to be consented or the cookies to be accepted. We need to be very, very clear on that what kind of consent we are giving. Once you give the consent blindly, definitely you are exposed to the entire world.
So true, so true,
Yeah.
so true. Okay, I think we have kind of come to a conclusion of our discussion today. Maybe next 5 minutes we will open up to all of you to kind of ask any open questions that you have on this subject.
Sure. Ladies and gentlemen, a big round of applause for this wonderful panel here. Now, in the interest of the time, Chandan, maybe we can take one quick question, but the honorable panel members are available after the session if you want a one-on-one discussion with them. So can we have a quick question? Please raise your hand and please limit it to one question. We have a question. Sir, if you could keep raising the hand for... And if you could direct the question to the respective panel member. And if it is a generic question, you can, I think Chandan can decide which panel member would be the ideal.
First of all, good afternoon, everyone. My question is related to how banker valuer evaluates for a under construction property, how he evaluates the insurance. Property insurance. Suppose if a property value is, let's say, 1.5 crore and it's 90% it is completed, the valuer values it at 20 lakhs. So against it, bank is exposed to risk, credit risk. So what is the use of, taking a 20 lakh insurance? I mean, and second question is whether it is mandatory for customer from compliance point of view of RBI guidelines.
If you could also introduce yourself and your organization.
Yeah, so my name is Mithil Karekar. I'm heading risk for Apex Stock Brokerage Operations Limited, which is a fintech startup since last 1 year. And I'm in this domain since last 16 years, more than 16 years, and I'm into a risk management domain.
Thank you. Thank you for asking such a pertinent question. I'll request Anil, because he handled this product day in, day out for last 16 years. So I think he's the best person to answer this.
So I would like to answer, you have asked two questions. First, I would like to answer the second question. You asked whether the property insurance is mandatory. So as per the regulation, the property insurance is mandatory if you are availing any kind of loan based on where the collateral is the property. So it may be a secured business loan, it may be a LAP loan, it may be a MSME loan backed by the property, or maybe a housing loan. More importantly, into housing loans. Second question, you asked that the property value, the overall property value is 1.5 CR. But when the insurance is happening, the insurer valuer is calculating only 20 lakh value for covering the insurance. So, yeah.
So it's not the property insurance company, it's the valuer who has been appointed by the bank, external valuer, which is under, or you can say a bank legal team or a compliance team.
So the thing is that we bifurcate this question into two parts, two kinds of properties. One property is basically a standalone house, row house. One is the flat in an apartment. So you look at when you buy a flat in an apartment, so there may be a 500 apartments, there may be a 500 flats built up into that particular land. In the sale deed, it is mentioned that your build-up area is so-and-so, and plus you have the equal share in the land value. So basically, land value ka share would also be counted in the property cost or the property value. But when you go for the property insurance, why the property insurance? Because if your property get damaged because of any unnatural calamity, So that is the insurance, what insurance company covers. Now land, nothing can happen to land. So land is always there. So that's the thing that when valuer defines a total property value, he defines into two parts. What is the construction cost and what is the overall property value. And since if somebody is buying a property 1.5 CR, definitely there is no meaning of taking the property insurance for 1.5 CR because ultimately insurance company will cover only the construction cost of 20 lakh. So that is how your valuer gives a breakup that what is the land value and what is the market value. If I take this example in a parlance of Mumbai property. So Mumbai, you all people know that what is the high cost of the land. So usually if you look at maybe almost 90% of the property value comes from the land value and hardly 10% because construction cost is a fix. If you look at in the Mumbai, a normal flat, the construction cost is somewhere around 2,000, 2,200 per square feet. It is a lavish flat, it would be going somewhere around 3,000 to 3,300 per square feet. So that cost is fixed. Now it is the land value, whether you are buying in a South Mumbai or where you are buying in a suburbs or the central Mumbai.
Thank you, Anil. Thank you.
Thank you so much. Now, ladies and gentlemen, I would like to call on stage Dr. Ajit Karunakaran from Writer Information Management Services. Doctor, if you could kindly come on stage and do the honors of felicitating this wonderful panel here. Thank you so much, Dr. Ajit, for doing the honors. We'll start with Mr. Ankur Jain, AVP for Credit Digitalisation from Tata Capital Financial Services. A big round of applause to Ankur for his wonderful contribution on the panel. Mr. Siddharth Purandare, Head Credit Risk MSME from Edelweiss Retail Finance. A big round of applause to Siddharth for his wonderful contribution in the panel session. Mr. Kaushik Khanna, CRO from Ambit Finvest. A big round of applause to Kaushik for his wonderful contribution in the panel session. Mr. Anil Jain, Head Credit Aadhar Housing. A big round of applause to Mr. Jain for his wonderful contribution in the panel session. Mr. Vaibhav Joshi, co-founder and CEO from EasyPay. A big round of applause to Mr. Vaibhav Joshi for his wonderful contribution in the panel session. Mr. Yogesh Thakker, Associate Director from CreditRisk Solutions. A big round of applause to Yogesh for his wonderful contribution in the panel session. And our honorable moderator, Mr. Chandan Mohapatra, Head Credit Risk from FlexiLoans. Thank you so much, Mr. Mohapatra, for that wonderful contribution to the panel session as a panel moderator. Would request all the panel members to kindly come forward for a group photograph. And Dr. Ajit, if you could also join them for the group photograph. A big round of applause, ladies and gentlemen. Once again, fantastic panel of experts here. Mr. Ankur Jain from Tata Capital Financial Services, Mr. Siddharth Purandare from Edelweiss Retail Finance,